Welcome to Value Research Helpline. I'm here to answer your questions and let me start. Vishal Bhatia is asking that can I enter in the stocks recommended in the stock advisor which are currently showing negative return from their recommended levels? Yes, by all means. When we think a stock is not worth investing further, then we put it in hold or sell. If there is any stock, and there are quite a few, we have recommended made 3-4 sell recommendations. We have put quite a few on hold. So, but I would say that if you are getting started, choose from the best buys. The best buys, the 15 stocks, you still have some stocks which are below their recommendation. When we first recommended it, they are lower from the prices are lower from those levels, and some of them are quite. I'm hopeful that the stocks in which the prices are lower than the recommended level in the best buys looks like the best buys from the losers list. So yes, by all means, go ahead. Victor D'Souza is asking that I'm 67 years. I get a monthly pension of rupees 44,000. I've invested in rupees 15 lakh in senior citizens saving scheme and rupees 9 lakh in post office monthly income scheme and in Kisan Vikas Patra and NSC. I still have rupees 20 lakh to invest now. It is better to invest in a debt fund, and as I'm the 30%, I'm in the 30% tax bracket, or in other fixed income fund. Oh, your plan is very straightforward. You have if the income from all these investments, the pension, the senior citizen savings scheme, you'll be getting close to every quarter you'll be getting annually you get about 135. So that will be that plus the post office monthly income. So all the money, if it is good enough for you to support your income requirement, all the money that you need every month to sustain yourself, then my suggestion will be that of the 20 lakh rupees, invest in equity. Now, where in equity, dominantly equity. So I think, for somebody like you, and spreading the investment will be important. So this 20 lakh rupees should be invested in an aggressive hybrid fund or a balanced advantage fund. Remaining money, all that you have is in fixed income. They will remain constant. The principal will remain constant, and you will get reasonable, or you are getting safe return from these investments. So to ensure that the worth of your investment is not depleting, you must invest in equity. But equity is scary, so that is why I'm suggesting these two guidelines. Spread your investment over the next 2 to 3 years and invest in an aggressive hybrid fund or a balanced advantage fund or maybe an equity savings fund to make sure that you're able to beat inflation by a wide margin to support the worth, to protect the worth of your capital, even the money which is invested in fixed income. So this is a simple plan that I have. And one important thing which I would like to guide you is that because you are in the 30% tax bracket, you should make sure, because you have to invest in equity. So why not invest 1.5 lakh rupees every year in a tax saving fund? Because by now, because of one-time investment in senior citizen savings scheme would have given you that advantage. But if you are able to invest 1.5 lakh rupees in tax saving fund, out of even by recycling a part of the money, then that will be deducted from your income, and maybe it just might lower your tax bracket. Anand TS is asking that I am serving as a Lieutenant Colonel in Indian Army. I am 44 years old, investing in NPS-Tier 1 of 50,000, Tier 1, 50,000 rupees since the last 3 years. Full pension applicable. Is it better to put extra amount in addition to SIP of 28,000 rupees in various mutual fund and about 4 lakh in stock in NPS-Tier 2 fixed income instruments as a CNG scheme rather than keeping bank FD? Yes, if all your money is in bank FD and you're still far off from your retirement, it entirely depends how far you are from your retirement, what will be your pension from post-retirement. Your contribution to NPS of 50,000 rupees over the last 3 years will not be good enough to support any income, because your contribution is 1.5 lakh rupees. Even if you put more, it won't be meaningful. So I would say that if you're keeping your money in fixed deposit, you must, if you have couple of years, you must invest in at least a part of it in equity. You should start estimating about what your income, what your post-retirement income will be on account of pension. You should also look at a significant part of your money goes towards Army Group Insurance contribution, which is actually a insurance-linked invest saving scheme. So you should look at the balances there, and those funds might be giving you a decent return, but it is not an entirely a equity fund. And it is also coupled with the insurance protection which you get as an army personnel. So I would say that you require careful planning. Keep it simple. If you can't do anything, put all your 1.5 lakh rupees in tier 1, remaining money in tier 2. Have maximum amount in the equity plan, because you should invest in equity only when you have time on hand. And if you are few years away from retirement, you should be in equity. Only as you get closer to your retirement and you intend to derive income from your investment, then only you should think in terms of moving to fixed income. So fixed deposit doesn't make sense except for the money which you are likely to need in recent future. Recent future meaning for any expense for your child's education. If it's getting into college, you need a lump sum amount, and all that money which you definitely need in foreseeable future, 2, 3 years, 4 years. Except for that, rest of the money should be for the long term, and you can do it either by way of equity funds or aggressive hybrid funds, and nothing else. Then you have the NPS account, invest in the tier 2, invest maximum in the equity plan. You can today it is possible to invest 75% of your allocation in NPS into equity. Swapnim Mangle is asking that are floater funds helpful in reducing debt funds risk in fixed income space? Also, advise what are the ideal investment horizon for such funds. Let me just explain. There are 3 parts to this question. One is that what are floating rate funds? Floating rate funds are funds which invest in floating rate bonds. Then the question is, what are floating rate bonds? Floating rate bonds are bonds issued by companies, where most bonds are issued with a maturity, 10-year bond, and there is a coupon. And depending on the credit quality, quality of that company or financial health of that company might give you high rate of return if the company is in poor financial health, because there is a greater risk of default. And if the company is in its great health, great financial health, then the coupon or the interest payment will be lower. Floating rate bonds are something where the company doesn't give you for the term of the fund, for the term of the bond. They don't say that you will get 9% over the next 10 years. It says that the interest rate will be reset every year in line with the changing interest rate. So there is no guarantee of interest. There is a guarantee of interest that it will be reset. You don't have the long-term guarantee of interest. So if today the interest rates are low, the floating rate bonds actually make sense, because tomorrow if interest rates go up, then these will be revised upward. But in good times when interest rates are at a higher level, then it doesn't make sense, because they will also get reset when interest rates get lower. And in India, we don't have too many floating rate bonds issued by the companies. So there are derivatives which are created whereby the fund managers buys those derivatives to create artificial floating rate bonds. They buy the bonds and they buy derivatives, options, whereby the character of the bonds change. And so put and call options, put options, or to ensure, and derivatives mounted around that. It's a complex formula, but that is how it is made available. So floating rate bonds or floating rate funds make sense when you are investing in fixed income funds at a time when interest rates are low and they can go up, and then you will be deprived of that. So they will be revised upward. So after I have explained this, I think it becomes self-evident that what is the ideal investment horizon of such funds? It doesn't matter. The interest or the return from such funds gets revised in line with the changing interest rate. And you are asking that, how safe are they? it has nothing to do with the safety of the, all these things which I'm referring to. They are talking of the interest rate risk. The other significant risk of debt fund or debt or investing in bond is that how assured are you of getting your principal back and interest on time? And that is the credit risk. What is the likelihood of a company defaulting on its payment to its bondholders? And that is something which depends on the rating. I would say that err on the side of caution. Floating rate funds or not, it entirely depends on the kind of credit they are taking. So just be careful. Also, I feel that, floating rate funds, there are 2-3 red flags, or, red flag in the design. One is that we don't have readily available floating rate bonds. The other is that it has to be artificially created, so it requires certain transaction and cost. Third is that you will get interest rate little more than in line with the prevailing interest rate. And then mutual funds will have expenses. So, the prevailing interest rate minus expenses will turn out to be, prevailing fixed income return. Nothing more, nothing less. So don't expect anything dramatic. And what are you trying to guard yourself against? You are trying to guard yourself against interest rate rise, which will enhance the return of some of the bonds, but these bonds will also get reset. Why not be there are other ways of simpler ways of achieving this. So I would say that today it has come on the forefront. 2-3 floating rate funds suddenly have posted some decent return, and investors are getting attracted to it. But no, they have been in existence for a very long time, and I don't think they have any earth-shattering performance for you to really get attracted to them. Mr. Pandey, SR Pandey is asking that. Oh no, I just missed on one question in between. Sunil Khadwala is asking that please suggest how long-term mutual funds, a few long-term mutual funds for my kids' future with 10 years horizon. Oh, choose a good equity fund. And I would say that 2 guidelines. I assume that you are going to do your SIP. You start investing regularly for your kids, and choose a multi-cap fund. Choose a large and mid-cap fund. 1 or 2 of them, and be at it. One important thing which you have to remember 5-7 years from now, as your children get closer to as you get closer to requiring that money, steadily start taking money out and move into fixed income, so that you are not dependent on the market for actualization of that goal. Now I get on to Mr. Pandey's question. Mr. SR Pandey is asking that liquid fund is giving low return nowadays. Is it worth to shift amount to short-term debt fund from liquid fund after paying short-term tax? Yes, paying short-term capital gains tax on liquid fund is inevitable, because mostly your very short-term money should be lying in liquid fund and ultra short-term bond fund. So you end up paying that tax. And there is no short-term capital gains tax, because in case of that short-term, if it turns out to be short-term capital gains tax, which will generally be a holding of less than 3 years, then all the income is added to your all the gain is added to your income. So you will be taxed at marginal rate of the tax bracket you fall into. Enhancing the return, yes, I think it is an important goal. Interest rates are very low. Liquid fund returns have crumbled. Overnight funds are still lower. Even ultra short-term bond funds are not giving anything meaningful. So I would say that low duration fund, get there. And if your money is for 1.5 year, low duration, and a fund which is keeping away from any low quality paper, you will have to be a little careful, because now ever since Mr. Risk visited that bond fund, one has to be a little careful. So and don't necessarily chase or get attracted to or be after the fund which is giving the highest return. So maintain distance, social distancing, financial distancing. So keep away from that. Don't be after the highest yielding bond fund. That itself is the risk, is the biggest risk. Okay, Satish Konitala is asking that I'm aware of, in REITs, I'm aware of dividend risk and capital risk due to demand supply of stock. Is there a management risk or bankrupt risk by taking new loans for more development? Is SEBI or REIT trust set up good to monitor these to protect us? What allocation do you recommend between debt and REIT for monthly income? I would say keep off from REIT for now, because the market, we have very few REITs. They're still evolving. Even the regulators are learning how to, it has taken a couple of years for it to tweak the regulations so that the first REIT could get going. Most mutual funds have actually enabled a provision that they can invest up to 10% in REIT, but I don't think they have really embraced it. They haven't gone about investing in them. So hold on, let it evolve, because REIT, this is going to be a big ticket investment. It has to be meaningful. And then the added risk is, there's one risk which is very inherent to REIT, assuming that there is no redeployment and a redevelopment, more development or investing for more development. I think, it depends on the prospectus. Different REIT offer documents have different provisions. It might have an expiry, or it might get into, newer development or not with the residual money. But the primary understanding of a REIT is that here is a closed-end structure which owns assets, and the rental income derived by this vehicle will be given to you as a cash yield. And hopefully, in the life of the fund, the financial worth of the assets which is producing this income, which is producing the rental income, will also go up in value. Development is generally not a very significant part, or is not a very prominent part, but let's see how it evolves. But I don't know, the expenses, the lack of occupancy, and and this is a threat which has become real. This is not a threat. This was not an understandable threat some time back, but ever since this pandemic and the crisis, I think it might be real, and it might have a very significant impact. And that is the kind of thing which can be which is true even for a landlord. If you are a small landlord with a you live in a floor, and you have rented your house, and if you don't find a tenant for a while, then your income disappears. So in that sense, even though some of the commercial real estate lease contracts are for a long period of time, but businesses change, businesses go, get into a poor health, or there could be a demand-supply equation where a lot of tenants will be willing to move on to a relatively cheaper alternative. So I would say that all those risks, all the market risk, all the underlying business risk very much prevail. So let it evolve a little bit. I think these are early days for an individual investor to look at it as an income vehicle. Sanjay Arora is asking that I am a service class person. I'm a small investor. I'll retire in 5 years. I'm a regular reader of Value Research, and I'm willing to subscribe to premium account for mutual funds. Do I still require a financial advisor? For my adult children's, student, I want to start SIP for long term. Can I go same mutual fund for both child? Sanjay, you don't need to necessarily subscribe to our premium service to get started. Get started now. Maybe I'll write you a mail where to get going. Procrastination is one of the biggest speed break or an impediment, or something in getting started. Get started now. And yes, and I think a lot of people will actually do without subscribing to our premium service, because our portfolio tracker is absolutely wonderful, and it's a free service. There are significant value addition to our free service, which will be on the premium account. We will be telling you how to, we will be recommending a portfolio customized to your requirement. That will be the premium service. We will be giving you a list of, everybody is asking that, give me the best fund for my need for a certain objective. We will give you the long list, a small list of best funds to invest. We will keep an eye on that best fund when they are no longer the best. They are no longer good. So we will be, our analysts will be tracking them, talking to fund manager, trying to understand what is, if something is happening to the fund, or if a fund is getting not doing as well. Is it a permanent reason? Is it a temporary reason? Do we understand it? Do we still trust it? If there is a trust issue, we will be the first one to flag it to you. And free service is good enough. The premium service will actually be, added, very intense layer of And I would not like to deprive many of our users who will find that, why pay for the service? We will still be at your service. We will still be educational. Read my first page columns, read 20 of them, and I think you will get a framework for, the value research way. Diversify, invest regularly, when to buy in, when to invest for equity. We will orient you to be well off over time. That is our commitment. Premium service is going to be an added layer which will provide you, greater confidence. A lot of times people are looking for a second opinion. Our good enough information is good, but you still say, is it the final? It's the best, or is it okay? So reaffirmation, reconfirmation, analytical layers, which I think is very, very sophisticated. The primary reason why we want to launch our premium service is also that we want a service to be self-sustaining. Technology investments, it requires investment. It requires, and we want to really shift to a business model whereby you pay us and we work hard for you. And I want to have a straight connect with you people. You pay us the money, we work for you, and we make sure that we are running a profitable setup so that we are able to provide this service to you for a lifetime. We are not a funded business. Value Research has run as a profitable standalone entity for the last 30 years, and we want to continue to do that. Exactly the kind of dignity which I want every Indian earning person to have, because of only when he acquires financial independence. That is the way I run a Value Research. We run it exactly like a household. How much do we spend every month? How much do we earn every month? And do we have a modest profit after paying taxes? And do we have enough to reinvest in the business so that we can serve you better and serve more people and make little more profit, and then invest little more, make little more profit? So that is how it is. Value Research was never funded was never a funded entity in that sense. It has only run out of its cash revenue, the money that you pay on account of subscriptions, and the money that we get from our advertisers. That is how it runs. And I think our dependence on advertiser is coming down dramatically. And if a lot of you people buy our service, maybe we will make it ad-free. Kembe Venkatramana Rao is asking that, is there a correlation between AUM return and returns? Yes, there is a different kind of correlation between AUM return. In case of course, the law is that when AUM goes up, when fund gets larger, the fund companies are supposed to charge lower expenses. So, assuming that two funds give you exactly the same kind of return or generate same kind of return from their portfolio, the larger fund will get you a higher return simply because they have to charge less. The expense ratio, assuming that there are two funds, one is a 5,000 crore fund and the other is a 20,000 crore fund. So the 5,000 crore fund generating 10% return will charge higher expense, and the 20,000 crore fund generating 10% return will generate lower return. We will charge lower expense, hence higher return. So that's one kind of correlation. The other is that, in case of debt funds, because of the competitive pressure, the larger a fund gets, more competitive it becomes, and sometimes it charges less. So I would say that, this is one expense relationship. The other is, the maneuverability, flexibility, and its ability to demonstrate, performance based on various, freedom of strategy. So think of a multi-cap fund. Most of the multi-cap funds came into trouble because of the regulatory move that every fund is supposed to invest 25% into small cap and mid cap as well. It was entirely driven by the fact that most multi-cap funds, when they succeeded, they got so much money that it did not make sense for them to be investing in small caps. But if it remained a small fund, then it was possible for it to do whatever it wanted to. Because my sense is that a small fund will be deprived of many investment opportunity or stock opportunity, simply because it has turned big, and making a small investment in a compelling company also will not have a meaningful impact on their overall performance. So my belief is that a relatively smaller fund is more maneuverable, and we have seen that some of the smaller funds which have existed in the past and have done exceedingly well, they did very well when they were small, and they turn out to be not so impressive when they turn big. So equity fund, bad is big. There is also a theory that what is called winner's curse. When a fund does well, more people put money. When more people put money, it gets very difficult to replicate the strategy that it has followed in the past, or the kind of things that it has done in the past. The big becomes an impediment. So size becomes an impediment. So I would say that there could be different thresholds. For example, my sense is that bigger than 2,000 crore small cap fund could be big. Bigger than 5,000 crore fund of a mid cap fund could be big. Bigger than 15,000 crore fund, a multi-cap fund could be very big, could be big as well. Index funds, bigger the better, because it does not require great effort. Larger fund, lower expenses, and it translates into superior returns for you, or expenses are lower. So work on your threshold, and this to my understanding is going to be one of the biggest problems. Which is leading to disenchantment, or which is leading to disappointment of investors in mutual fund, because this is one thing which is actually at odds. One is that fund companies make money when they manage more money, and you make more money when the fund is small and it does much better. Your 10 rupee becoming 50 is one thing, but a fund company also gets new investors put in to make it even bigger, and they make even more money. So this is going to be at loggerheads, these two goals, and this is going to be a serious problem. Venkata Raju Vadula is asking that I have investment in mutual funds in regular schemes. Now, if I switch them to direct schemes of the same fund, whether my return will improve? Yes, absolutely, to the extent of the difference there is in regular and dividend plan, in direct plans, and but these returns will become. Of course, you should do it. And you should do it as soon as possible if you are not seeking somebody's help. But these returns, when you do the calculation, you will only understand that in 5 years, 10 years time, it really becomes meaningful, because these are, recurring regular expenses, which is marginally higher. And assuming that, think of it like, your money growing at 10% and your money growing at 11%. This is the kind of difference which will be there in regular, or, your money growing at 10% and your other money, in the direct plan growing at 10.75%. This is going to be a definite difference, and this definite difference over a period of time, the compounding effect of that is going to be quite substantial. Do it. Rajiv Mehrotra is asking that I'm holding Franklin Blue Chip since 94-95. Presently, it is not performing well in the last 2-3 years. Should I redeem and switch to Axis ICICI Blue Chip Fund? Yes, please. It has lost its game. Not 2-3 years, last 10 years. It has struggling to beat the index, and by a wide margin. It has slipped in a very gradual manner. So it's time to give up on Franklin Blue Chip. Puneet Seth is asking that I want to invest 10 lakh to earn regular monthly income. Please suggest in which mutual fund should I invest? My age is 50 years. 10 lakh to earn regular monthly income. If this is the first investment that you are making, I don't know, you need a more comprehensive plan, because you will have no other income, then it requires something else. I would say that, if this is the only capital that you have from which you have to derive the income, which you will be depending on, then don't invest in a mutual fund. Go to a post office and put that money in a post office monthly income plan. That will give you the guaranteed income. It will be lower, but then much higher than the bank deposits and other things. And if this is your only income getting derived, then it will also be tax-free to the extent that it will be lower than, all your income will be lower than the income tax threshold that we have in this country. But unless you share more information, I really can't work on incremental plan. And this is a dangerous plan, in a sense that if you consume all the income derived from post office, which will be about, which will not be very substantial, assuming 8%, so it translates into even 8% is difficult, 7% or 7.25%. So this will be about 70,000 rupees a year, and 70,000 rupees a year translates into 5,500 rupees a month. And so share more information. all that you have, any other investment that you have, any other source of income, I might be, but this is the simplest thing. And the risk I was pointing to is that this will remain constant. Maybe the interest rate might go up at some point by 0.5%, 1%, but nothing big. Your capital will remain constant. Your 10 lakh rupee will remain constant, and the return that you are getting on account of interest, you will consume that. So 5 years from now, your life will be difficult because your need for a higher income will not be met. So you need a quick plan, and we need to have more information to be of any help to you. Prashant Tikade is asking that I want to buy a second flat, 1 BHK, by selling a plot and taking rupees 12 lakh loan. Rental income will nullify the EMI. I want to invest in safe asset. I have a long-term horizon. Please guide me for the same. I don't know if it's you already have a plot. I have a basic principle. This is your second flat. You already have a home in which you live in. That's great. It's not an investment. It remains a home. And if it is saving you on your rental outflow, that is nice. Selling a plot and buying a flat, from which the income will be able to support the EMI, and the plot's capital money will also get invested. It may not be a good idea. Flat has two components. One part which is you own a piece of, you have a proportionate ownership of a land, and then there is a construction. Flats depreciate, land appreciates. So you will be buying half of your money for which you are borrowing will be a depreciating component of your asset. So I would say that this is an investment. Why get into the mess? You already have an asset, and you already have a plot, which is an asset, which can be realized at some point, and hopefully it will appreciate too. And you are not creating a debt. If you don't borrow money, you will not be liable for EMI. So that's okay. Go for this asset only if you think that the flat's value will appreciate substantially and dramatically as compared to the plot. And if that is not the case, why go for it? Land will appreciate, and you will be a proportionate ownership of it without the mess of borrowing money and paying the EMI. And just in case there isn't a tenant, you will be liable for the EMI. So you have a risk there too. And nothing prevents you from holding that land for as long as you want to. It's your long-term horizon. So moving to the next question, Pradeep Seli is asking that, okay, he's not asking, it's a suggestion. You should offer 5-year subscription plan to your mutual fund recommendation service at very cheap prices, because we are advised to invest for at least 5 years. Okay. Moreover, the service should be affordable for a small investor who invests in small amount every month. Yes, I think it's a great suggestion. I'll definitely consider it. And yes, it absolutely makes sense. Sometimes I think that, why go after, we keep telling people that invest for the long term, have 5 years time frame, and we don't offer 5-year subscription. Thank you, Pradeep. We will give you a subscription of 5 years, especially for you, even if we don't provide it to everybody, as a generic offering today. But I take your suggestion. We will definitely enable you to subscribe for 5 years, and surely, and 5-year subscription at lower cost is actually not a favor to you. When we give a 1-year subscription, a lot of, it's a marketing gimmick. We say that, okay, here is a 1-year subscription for 100 rupees. And here is a 3-year subscription for 250 rupees. It looks like a 50 rupees discount on a 3-year subscription. But what you are forgetting is that, you are giving the money to us in advance, and that money works for us because it gets invested. Money given today for next 3 years is not equal to money given every year. So we are not doing you a favor. You are entitled to a discount simply because you gave us money in advance. And that is the thinking, which guides our pricing as well. So, yes, I take your suggestion, and we will have more advance money coming from our customers. Venu Gopal is asking that I have 50 lakh rupees, which I have received as proceeds from my bank FD. Kindly advise some debt funds to invest in for better post-tax return after the latest RBI policy. I do not require this money for at least another 5 years. I have stocks pure equity, international fund, and gold as part of my portfolio. Okay, so yes, having this 50 lakh rupee will provide you great stability, and you should have it. I would say that, today I'm very wary of, the kind of debt fund that we have and the kind of hidden risk, and risk comes as a surprise. It doesn't come in a very predictable way. So definitely look at, at Value Research online before you invest in a short duration fund or short term fund, or a medium term fund, even a money market fund. You have these ups and downs. So one is that, the 2-3 rules to follow. One is that don't take credit risk. So anything which has any modest, lower rated corporate bonds, and Value Research page on each bond fund will help you know that. Second is, don't chase the best performing debt funds. So if you follow these 2 rules in any of the categories that you have chosen, short duration funds, I think, your job will be done. That apart, the tax efficiency of the debt fund remains, in the sense that you are not liable to pay taxes till you actually don't take your money out. And if you are unlikely to need this money, unlike a bond funds don't expire. They are not closed-end structure. So, and you are not liable for any taxes till you redeem it. And if you hold it for more than 3 years, then you are entitled for the indexation benefit, which is great. Which will actually reduce your tax outgo substantially. My apologies for the hiccups. Nanda is asking that I started investing in NPS since 2018 Tier 1 regarding I invested via local bank. They have applied through Karvy Fintech. Sir, Karvy is becoming notorious for pledging the shares of client. Is my money safe? Oh yes, NPS, but the NPS structure is very unusual. NPS structure is that, Karvy doesn't have the money. The money goes from, from your account to the omnibus account, from where it goes and gets invested with one of the pension fund managers. There are pension fund managers to whom these pension fund service providers, the transfer agents, and NSDL and Karvy are the two entities. And Karvy Fintech, is unfortunately, has been into this controversy, and they have done something really nasty, very disappointing. And the SEBI is yet to resolve most of the problems that investors are facing, particularly on the brokerage front. They just stole people's shares. So yes, Karvy as a group, but I hope that this particular entity, the design of NPS is something which should be quite assuring, and I think PFRDA should look at this, because this is a real threat. One is to actually have a trustworthy system. The other is to make sure that the trustworthiness, nobody is able to point finger on that. Here are small, a lot of small investors who are putting their money, and the Karvy name itself has become very scary. I think PFRDA, I will write a letter on your behalf to PFRDA to do something about this, because the Karvy Fintech has become a new company, and now it has the Karvy promoters have some stake there, but they are no longer running the company. But if you as a customer or you as an investor are asking me about and apprehensive about Karvy, this is a problem to be addressed. Meena Kriplani is asking that I have a diversified portfolio of hybrid fund, mid cap fund, large cap fund. I also have a pharma fund, which I would like to add to. Is this a good time to add to pharma fund? And can I make a lump sum investment into thematic funds like an IT fund and a banking fund? What do you advise? I normally advise against all this. When you have a diversified portfolio of hybrid fund, mid cap fund, large cap fund, so they will be investing in IT stocks, they will be investing in banking stocks, and they will also be investing in pharma stocks. The best time to invest in pharma was a year ago, and pharma has gone up by 60%. Average pharma fund has gone up by 60% in the last 1 year. In fact, it has gone up by 50% this year itself, in 2020, in these 8-9 months. So the best time to invest, and before that it was struggling. There are still apprehensions about pharma, but they're still racing ahead, and we have some very high quality companies doing very well. And if you have a diversified portfolio, you have all of it. Why do you want to supplement it? If you already have substantial investment made into these funds, maybe you can make your all-time investment. The whole idea of doing a SIP is to average your investment in the early years of formulating your belief in market-linked investment, which is so volatile and scary. But once you have already accumulated, you are used to it, and most of your money which is already invested will be moving in so widely, and if you're comfortable with that, might as well maybe you can invest at one go, lump sum in 2-3 tranches, and follow some principle, whatever you are able to devise. But I would say that diversification is a great principle, and having a IT fund, banking fund, and pharma fund amounts to making it a diversified fund anyway. How do you allocate this? Where to invest now? Where not to invest? So keep it simple. I'm always a believer of simplicity in terms of keeping fewer investment, having few papers, making sure that you don't have to do too many tax reporting. You don't have to worry about all this, because these are all mechanisms. When your investments are scattered too much, as a result of all these that you are listing, that you have a hybrid, large cap, mid cap, small cap, and now pharma, IT, and banking, you will end up having a very weird index fund, and you are incurring the cost of actively managed fund, and you are having the active managed fund cost, and in 3 of the funds you will actually be giving a limited mandate to a fund manager that take this money and invest only in IT companies, and even when it is unfavorable, it remain invested there, and if it is favorable, it's fine. So the onus is on you when investing in a sector fund. It is your responsibility, not the fund manager's responsibility, that whether you should be in it or out of it, because it is a limited mandate. Those funds are supposed to invest only in that sector. Lalit K is asking that I have been gifted 1 crore by my mother. Congratulations, Lalit, on getting 1 crore gift towards sale of property, and I do not want to buy one from this amount. Please guide on investing it in details of various asset classes with names. My requirement is of investing it for the long term, minimum 10 years. I'd say it's a very substantial amount of money, and I would try. I would like to. If you don't intend to buy any, if you don't want to substitute this money with any other piece of asset, then I think the simplest way is have a, either an aggressive or a conservative allocation with your money, and spread this investment over the next 3 years. So my suggestion will be, choose 1 or 2 large and mid cap fund, or 3 funds, large cap, mid cap, small cap, in a certain ratio, and ratio also, something like 60% large cap, 20-25% mid cap, 10-15% into small cap. So you are represent and choose the best of the funds, and spread this investment, divide this 1 crore by 36, and that money should be invested in that proportion, what I was saying, 65, 25, and 10, or 65, 20, and 10, and 15. That money should be spread over the next 3 years. This is a simple plan which you can follow, and I'm sure that in 10 years' time, go and check the worth of the land which has been sold. I hope that it beats the worth of that. This portfolio value beats the worth of the land which has been sold. Kishore Kumar is asking that my daughter is 15-year-old and I want to start new equity fund in her name. How things will work out when in terms of long-term capital gains for me now and after she turns 18? Long-term capital gains, if anything is sold before she becomes a major, it will be treated as your income or your capital gains. And when she becomes a major and she redeems it, it will be her liability, her long-term capital gains or short-term capital gains, depending. So she will be she will become the owner of that asset, owner of the investment, and she'll be liable for all the capital gains as well. But it will be considered as a gift. So the date of gift, it will be, on attainment of majority of the child, from there on till the redemption, that will be a tax liability. Balaji Kesavan is asking that does LIC Jeevan Shanti is a good pension policy to look at? I have excess money with no immediate need. Should I park this in another FT or Jeevan Shanti? I would say that if retirement is a goal, then the best best retirement plan in this country is NPS. It is low cost, it is diversified, it gives you control, and that in itself, and it forces easy withdrawal, which I think for many people it works. It is a disadvantage, but for many people I think it works because it forces you to remain there, and you are not you are forced to not you can't take your money out. That itself works. Otherwise most of the time, little flimsy reason we take our consumer investments. So that's number one. Any investment that you make which is low cost, high performance, and for 10 years and more, any investment is your retirement fund, because the idea should be to grow your money. Jeevan Shanti, I haven't looked at it in great detail, but I generally don't have great impression of LIC's investment performance, which is the other policy, and also the annuity rates are not very favorable, and it can only get poorer over time as mortality goes up. So I would say that look at NPS, look at longer time frame, look at equity fund, not conservative investors look at equity savings fund, look at low cost, and and maintain discipline, be disciplined about it. That's your pension plan. A pension plan does not necessarily have pension in its name. If you have money and if you can derive periodic income from it, that's your pension plan. So thank you very much for joining me. I'll come back.